Welcome back to my channel, Balance Sheets Matter. I do individual stock analysis videos, so if you want to get good ideas on potential stocks to buy or value traps to avoid, make sure to subscribe to the channel and like the video. So how we do this is I dive into the financials, see what's good or bad about the company, and see what's potentially improving or getting worse to determine where the trend of the company is going and how we can use that to determine a potential value for the stock. So in this video, we're going to be looking at Pepsi-Cola. So this is normally a stock that mostly dividend investors like, and it's one of these stocks that's in the consumer packaged goods sector. And if you've noticed what's been happening with a lot of other stocks, a lot of them have been getting hit down really hard. So one of the things we're going to be looking at is Pepsi-Cola potentially at risk of getting caught in this huge downtrend as well with them. Since if you look at things like Campbell Soup, it's way down over 50% in the last little while. And there's a lot of others that aren't doing very good as well. So first thing we're going to look at Pepsi-Cola is just look at some of these top level metrics here. You can see first of all right now they have a P ratio of 24.75. And while this may look kind of expensive, they do have a forward P of 18.3. And what this means is the analysts are expecting their EPS to be higher in the future. So when we look at the financials, we're going to see basically why this is. Sometimes it's just because of a one-time expense, or it's because a lot of growth projected forward. Next thing is the dividend yield. Pepsi-Cola does have a dividend yield of 3.61, and this is a very stable dividend stock that a lot of investors like to look at. I believe they are Dividend Aristocrat stock, which they have been paying consistent dividends and raising them over many, many years. They do have a little bit of a higher payout ratio of 0.72, and they do have a good dividend growth rate, though, of 7.5%. So on average, in the last 3 years, their dividend has increased by 7.5% per year. Now let's look at the financials here. So the first thing is to see what basically the revenue trend is. And you can see the revenue trend line here, blue, the average is about 5%. And in the green, this is the actual realized one, which is pretty much just in line with that. And everything just, by the way, past this blue line here is based on the analyst estimates. So they are expecting that Pepsi is going to keep growing in line like it has in the past. And we can see in the past, the revenue has grown at an average of 5.7% per year, where the EPS has grown at 6.2% per year. A lot of times the EPS will grow because there is some share buybacks going, or sometimes it's also because their margins are increasing. So the first thing we are going to check out is this get an idea of what the return on invested capital is and weighted average cost of capital. You do want the return on invested capital to be higher than the weighted average cost of capital, since it means when they invest capital into a company, they're able to get a good return on it. And you can see it's sitting at 12.88%, which is, not super high compared to some growth companies, but this is fairly stable what they have realized in the past. Well, there's been higher and lower periods. This is pretty much average. And they do have a very low weighted average cost of capital, meaning if they do need to issue shares to raise more capital or issue debt, they can do this at a very low cost at only 5.7%. The next thing is we're going to check out the income statement and look at the revenue trends. So the one thing you'll notice with Pepsi-Cola here is over the years, they have had these periods where they have realized around this close to 6% growth rate. They have had stretches like this where the revenue doesn't grow very much, but then they do get jumps like this, which I will explain shortly. And right now you can see it has grown and we are starting to get another jump. The next important thing is, well, what is their gross margin? Because basically the gross margin is what the gross profit is after the cost of goods. So typically companies, if they're losing their competitive moat, they may be having to reduce their gross margins to keep that market share. And this is one of the problems that did happen in a lot of other consumer packaged goods companies, such as Campbell Soup, is they did have to lower their gross margins. And this was a warning sign early on that showed some deterioration. But you can see right now, Pepsi-Cola, they're sitting at 54.06. And if we look at all these past years back to 2011 here, this is actually very good. They did have a high of 55.06. And I believe the low here is 52.02. So first of all, there's very little fluctuation in their gross margin. They're very efficient at it. It means they are a very good, well-run business in that sense. And they are near this upper end of this very narrow band. So that's very good. The next thing to look at is basically the operating margins, because a lot of times, especially when you're looking at slower growing companies, the operating margin includes your other overhead, including employees. And sometimes if you aren't growing your revenue very fast, these other costs can start exceeding basically the growth rate of your revenue, which slowly grinds down your margins over time. And right now they're sitting at 4.79. And again, well, this isn't the highest they have. If we look at all these past years, the highest here was, for example, 16.18. They've also had some lower ones of 13.15. This is kind of right smack dab in the middle. So they've had very consistent operating margins over this time period as well. So that's a very good sign. The company is very stable and is very predictable. And that is one reason that investors really do like PepsiCo. You may not get the biggest gains about it, but it's a very predictable and stable company. Next important thing is looking at the interest expense, because we do want to see that they actually do have a low interest expense compared to their operating income. And usually what I like to look at for a good kind of like ratio, which a lot of companies you'll see they try to kind of base this around, and if it does get too high, they actually will start paying down the debt, is about the 1 to 10 ratio. So we want to see the operating income basically 10 times higher than interest expense, and that is currently what we're sitting at. And if you can see in the past here, in 2020, 2021, when their interest expense, for example, did get up to 1.8 billion, which was above this 1 to 10 ratio, they did work to actually pay it down and get it back under that. So even though, well, this is kind of a general made up metric of my own here, it does seem to have a little bit of predictive power of where the company may allocate some capital, since if they are going to allocate their capital to paying interest expense, you're not going to be able to do as many share buybacks or acquisitions. So it's good to know that right now they're in a very affordable interest expense basically ratio here, so they can use their money for other means. The next thing we do see is in this other income expense here. And right now, remember we saw the PE ratio was quite high at almost 25, but they had a very low forward PE ratio of only 18.75, I believe. Well, this is because they have another operating expense that was just over $2 billion. And typically these are not actually like a cash loss, and exactly what it is in this case here. This is because they are writing down asset they bought through an acquisition. And Pepsi, it is a conglomerate. They do a lot of acquisitions. And at some point, when you bought a whole bunch of those acquisitions, you have goodwill on your balance sheet there. And you do, after a certain point, if the businesses aren't performing as they were expected, you do have to write this down on basically your income statement here, and you do have to realize the loss, even though you didn't actually lose any cash. So anyways, that explains why they have a little bit of a temporarily higher PE ratio. And even with that, that still does actually leave them at a pretty good net margin of 9.15%, because if you actually look at all these, past histories here, there has been lower, where it was like, 8.77 the year before and 7.65. So the very fact that they have this really big write-off here of $2 billion and a 9% net margin, this does show their net margin is on the higher range of things right now, which is showing a lot of strength and stability in the company. And we can see in the EPS here, it's 6.38, which isn't that quite the highest it's ever been. But probably if we didn't have this one-time write-off here, it actually probably could actually be at the highest it's been. Now, like I was saying before, with the shares outstanding and buying back shares, well, Pepsi does buy a few shares back in the long run. They typically don't buy very much. Usually companies do issue shares along as some of their compensation, so they have to buy a little bit back to offset that. But Pepsi, they don't really decrease their share count that much, but you can see it has slowly decreased a little bit over time. They are more of a dividend stock, so they do like to allocate their money towards paying dividends instead, since that's kind of the investor group they more attract. And while I may not be a specifically dividend investor myself, I do sometimes like buying these stocks for various other reasons. So we look on their balance sheet. The balance sheet overall, we're not going to go into too much detail, because for the big companies, things like the current ratio isn't really a concern. That's only really gets important for smaller and mid-cap companies. But we do like to look at the overall kind of financial situation if they have any excess equity. So you can see there's $110 billion on total assets on the balance sheet. And they do have goodwill of $19 billion and intangible assets of $34 billion. Intangible assets are usually something that is kind of a little bit more real, like the brands, where the goodwill is just the excess value they paid over the assets of another company they bought. So, usually when there's write-offs happening, it's happening on the goodwill front. You can see how the goodwill has, increased some little bits in the past here. So we have to remember we have about $19 billion of goodwill and $110 billion on the balance sheet. And that leaves us $21 billion of total equity. But if we do take out that goodwill, you can see how there's really no additional equity in the balance sheet. And all this really matters at the end of the day is when we're valuing a company and its valuation. If there's actually a lot of real tangible equity on the balance sheet, we have to look at their market cap and realize that there's all this excess equity there, that we have a chunk which is basically the company and its growth. and maybe extra cash and assets on the balance sheet, which can garner a higher P ratio versus if you have a lot of negative equity, well, that might garner a little bit of a lower P ratio. Where right now, Pepsi is kind of flat right in the middle, so it's not actually hurting or helping. But overall, as we already know from their interest expense, their interest is very affordable to them, and they have a little bit over $42 billion of debt. And if you calculate it out, you would actually see it's a pretty low interest expense ratio because companies like Pepsi are almost like government bonds in a way when they issue their own bonds there, and they can get very attractive interest rates because of the stability, like I showed in the income statement there. So let's see what's happening on their cash flow statement. So one thing that a lot of people overlook, but I obviously like to look at, is basically you look at the cash flow from depreciation and you compare it to the purchase of plant, property, and equipment. This can tell you a lot of things. If companies are growing, it typically is a little bit higher. So even though they're only expensing so much in the past year, in these, like for example, 2020 to 2023, they were spending more on purchase and property and plant and equipment. And in the future, those have to get expensed. And what we can see basically now is years and years later, the cash flow from depreciation has increased a little bit. Now it's at $4.2 billion. And then the interesting thing now is they actually have slowed down a little bit their plant, property, equipment, and it is a little bit more at replacement value. So where this may have been a little bit offset in the past, which could have predicted a little bit of slowdown in the short-term basic EPS, right now it's at quite basically a basic level. So if we took out that one-time expense, what we're kind of seeing on the income statement is actually a little bit more reflective of their cash flow. And as you can see, there's a very small amount of stock-based compensation. Usually it's only the tech companies that like to do a lot of stock-based compensation, only $304 million. Now, the next really thing that's important for Pepsi, which does drive a lot of their actually revenue growth, is the purchase of businesses. Now, these are the acquisitions. This is where the goodwill comes from. And as you'll see here, let's just go look back at a few of these dates. You can see how there was three larger acquisitions between 2018 and 2020 of about 1.5 billion, 2.7, and just under $6.4 billion. And as I previously alluded to on their income statement, which if we get back up there, they were actually flat in their revenues right up until those dates. And then after they did those acquisitions, that really provided a reacceleration of their revenue growth going forward. So Pepsi is a good and strategic acquirer of other business when the opportunities basically occur. As you can see, they've fixed into their business. They don't have the synergies to keep the operating margins high. And, that's a very good sign because typically when you acquire other business, you don't need all the staff from the other business. You can consolidate in yours, and that's when, synergies improve. That's when they, saying the analysts and everything, oh, they're going to create synergies from basically this acquisition here. So, what has happened recently with the purchases of businesses? Well, recently, they have done some big acquisitions, as you can see. In the last 12 months here, it was $2.2 billion. And if we just look at the year ending in 2025, which has a little bit of overlap, it was $3.04 billion. So this is potentially alluding that they are going to have a little bit of an acceleration in the revenue because of these acquisitions, because these acquisitions have basically just happened. And last time we saw this happen, it did help spur a little bit of revenue growth for the years to basically go forward. Since a lot of times when they do these smaller acquisitions, these are brands that are basically, growing going forward, where if we look back before 2018, the reason why the revenue was so flat, it's probably because a lot of the brands they had were basically stagnant and not growing. So that's why it's not necessarily like, oh, you just acquire a business, you see the growth next year. No, if they actually acquire businesses which are growing, they can see that growth helping accelerate for more years basically in the future. So that also is a good way to recognize if a company is doing good acquisitions, if you do see a little streamline of revenue growth even after the acquisitions occur. And you can see they do a little bit of repurchase of stock. They have been a little bit lower in the recent years. You can see basically after 2020, they've been only repurchasing under $2 billion of stock. And part of the reason of that is we can see that they are paying about a little bit of a higher dividend. We looked at that dividend payout ratio before, what was a little bit high. And right now their dividend is $7.7 billion and their free cash flow is $8.8 billion. And if we do look, for example, a few years in the past, year ending in 2024, cash flow from dividends, they paid a little bit over $72 billion when that was basically the free cash flow. Now, Pepsi, because they really are a dividend stock, I actually would expect them to keep increasing this in the future. but they're really not going to be able to keep it at that much of an accelerated rate. But depending on this gap here, I actually would expect them to probably favor doing more dividends than doing share buybacks. So I honestly wouldn't expect them to reaccelerate the share buybacks anytime in the short-term future, unless basically this grows a lot more than expected, the free cash flow, and they are still able to raise that dividend at the same time. Since again, dividend investors like Pepsi, and they want to see the dividend growing, and they've been historically 7.5% per year. Okay, now with that, we're going to jump into the interactive chart, and that's going to help us give an idea of starting to figure out what could be a good valuation basically for Pepsi. So the first thing I like to do is look at the revenue with estimate and the EPS with estimate without NRI, which is non-recurring income here. So you can see it basically is expected to, grow at the future at the expected rates here. A lot of these, at a little bit above that, 6% rate for the EPS, probably on average. So pretty much in line with what was expected. And now let's check out the dividend yield, because, this is what dividend investors basically care about. And it is also something that you can kind of use to value a stock. But we do have to take in other considerations, which we've mentioned before. And if you do look on this longer term trend, whenever you have the relatively higher dividend spikes, that actually has been when the stock's been relatively low. But then one of the questions is, why did it spike basically so much higher recently? Well, part of that is because in the recent years, they have had a little bit of a higher dividend payout ratio. So let's go dividend payout ratio here. So if a company is paying out a higher dividend payout ratio than they historically have, this is a reason, for example, why you would expect a higher dividend yield. And you can see kind of after 2020 here, the dividend payout ratio was because of basically COVID and everything there, and they had, that's why it was so high there. But you can see relatively other than that, this is the highest dividend payout ratio they've had. So that does explain why, for example, comparing to a lot of these past years, you would want to expect to see a higher dividend yield. Because if we compared it to a lot of these other levels here, if you had bought it here, this did look like a relatively high dividend yield, but you would have also had noticed that the dividend payout ratio was also a lot higher. And also now there's the interest rates a little bit higher too, so there's a little bit of competition against the bonds, and that's why the ratio at the bottom, the dividend yield, did reach all-time high when it was at the low. The next thing we can look at is the price to earnings ratio, the PE ratio. So let's just get that up there. And we can see right now it's 24.75, but if we did take out that one-time expense, we probably would be a little bit closer to a 20, which is a relatively low PE for them. And you can see in the past, a little bit after 2010, they basically have traded as low at the very, very low side of about 15. And you do have to remember, when you get this one weird year like this is typically because they had a one-time gain, or when it's really high, a one-time loss. You kind of need to factor that out a little bit to come up with an accurate estimation. And another thing is that's nice to look at actually for a very consistent company like Pepsi, and we're going to help us determine a good price for it, is let's look at basically the median PE over the last so many years here. And we can see actually the mean PE has been 21.77, and we can chart that here to get an idea. So let's just call it 22 just to make it simple there. And this will give us what we would expect, if I can get the whole thing to pop up here, of potentially a fair value in the future based on analyst estimates if basically the PE was 22. And you can see here by 2028, that would put about a fair value of $200 on Pepsi. Now we're going to jump into my chart. It's a little bit of, technicals and just price projection, but the technicals actually do have some fundamentals behind it. I do have basically this trend channel, and consistent companies, a lot of companies, they kind of do have these trends. And this is just a nice way to visualize when it's low, that's probably when you want to buy, and when it's high, that's probably you want to sell. And the reason I have this here with the percentage is you can see this trend is not completely made up. This actually matches their EPS growth, maybe a touch under it, but therefore a little bit more accurate because it's going just over the past 10 years actually of what their EPS basically growth is. So determining if you want to buy Pepsi or not, that's more of like a personal basically decision, because if you basically take their 3.6% dividend yield, you take 6% growth, you would average over the long term, if you bought it at fair value, of a little bit under 10% return. And for a lot of people, they may not feel like that is that much, but you have to consider how much is it below the medium trend, or is there a chance that if it gets above the medium trend, that's where you're basically making the spread in the difference and some extra potential gains from Pepsi. So you can see right now, based on my trend here, they're about 13% under this mean trend. And if they were to get, for example, higher in it, then you could actually, into this mean part here, I'll just draw a line in the middle of the top, which, as you can see, has been a place where it's a lot of times reached in the past. You could say there is potential 31% upside along with their 10% revenue growth per year. So, that's basically how I'm looking at Pepsi. I've been already buying it all along these prices, like down here. I've been thinking it's a fairly good value. One of the other reasons I think it's a relatively good value is stocks like Pepsi is a more defensive stock, and it's more likely to do better in bad markets than other stocks. You can see, for example, in 2022, let's bring up a comparison here of the S&P 500. And you can see when the market was going down, Pepsi was actually slowly chopping up. Well, it was already relatively expensive, according to this channel here. It actually didn't lose anything, and it did gain quite a bit. And if you did take this philosophy, oh, I want to, get more defensive here, you actually could have made a good gain with Pepsi rather than dealing with this whole market drawdown and then basically flip out of Pepsi and then invest in something more attractive. And, if you look at a lot of these, other times too, when this 2019 decline happened, if you took advantage of this opportunity here, well, you wouldn't have had to participate with that big downside. You would have made a little bit of gains. Kind of a little same with 2015, 2016. And also this chart, doesn't factor in dividends as well. In 2009, well, everything went down. Pepsi did go down less though. And another interesting thing is, for example, in 2000, which I think there's a little bit of similarities nowadays with the AI hype and, the semiconductor build out, that there could be a little bit of a tech bubble going, that when the market actually did top and went down, Pepsi and actually a lot of other stocks, they went up. So, well, Pepsi, actually could be a good value right now, have a good amount of potential upside. Like I was saying, there's potentially, if you think it's going to get back to this type of valuation here, a little bit above on the upper side of fair value, which you would want to sell it at, that would be about 31% upside from there, plus the 10% per year that you would expect it to get from the growth and the dividend. Plus, this is a stock that, can potentially actually gain if there is a bad market. So those are the reasons basically I like Pepsi. And I think, to answer the question again, are they going to get caught with a downtrend like all the other food companies? Well, we looked at their financials, and they are a lot more stable company and has really good fundamentals compared to a lot of the other consumer packaged food companies, which I will cover in some future videos to show some of the deterioration that happened with them, which basically caused their big falls. So anyways, I hope you enjoyed that stock analysis on Pepsi. You can basically see my thoughts on it, get some idea for the valuation. It's your choice, basically, if you're wanting to buy it, but hopefully, this is not financial advice, but hopefully it gave you a little bit of insights. Make sure to subscribe to the channel and like the video.